We're hearing a lot of chatter these days by various countries accusing another country of devaluing their currency or manipulating their currency. So, in this mind map, I want to try and figure out what is this. What does it mean when somebody is devaluing, when a country is devaluing their currency, and potentially can it impact stock prices? So, the first thing we need to understand is what does devaluation mean? What is devaluing your currency all about? So, when a country is supposedly devaluing their currency, what that means is they are essentially decreasing the value of the local currency, of their currency, versus another currency. So, for example, there's a lot of talk out there that China has been manipulating its currency or devaluing its currency on purpose. So, what that means is if China is devaluing the yuan, means the value of the yuan is falling versus another currency. So let's just say US dollars. I think that's the common valuation comparison. Said another way, let's say, if the US has been depreciating their currency or devaluing their currency, that would mean that the US dollar, the value of the US dollar is falling versus euros or the Canadian dollar. That's essentially what it means. Currency devaluation means depreciating the value of your currency relative to another country, another denomination. So, how do you do that? How can countries devalue their currency? Well, there's a few ways they can do it. One way is through their central banks, they can lower interest rates. By lowering interest rates, it reduces the demand for local bonds, which means there's not much of incentive to buy the currency to buy those bonds if nobody's buying those bonds. Another way they can do it is central bank can go out and sell their local currency and then buy foreign currency. Classic example are bonds, for example. Classic example right now, the dynamic that's been in play is China has been buying a lot of US bonds, treasuries. And the logic being, if it's buying more bonds, buying more US bonds and holding more of its assets in US dollars, then it's essentially depreciating the value of the yuan. So that's the sort of the mechanics of it. So that's great. If a country is devaluing their currency or their currency is falling in value, what are the implications of that? What are the impacts in terms of stock prices? So let's just think it out. So let's just use an example where we're looking at the US dollar and it is falling relative to the Canadian dollar. So we have the US dollar has been falling versus the Canadian dollar, which conversely is increasing in value. What that means is in the US, and in the short term, prices of US goods are going to be cheaper versus Canadian goods. And if they're cheaper, that means there's going to be more demand for those US goods. And what's going to happen is if there's more demand for those US goods, then US companies that are making those goods, they're going to export more. They're going to increase sales. So if they're selling more goods, to outside to foreign countries, foreign customers, they're going to increase sales. And if they're increasing sales, they have a pretty good chance, if they're running their business properly, they're going to increase profits. And if they're increasing profits, then chances are that's going to contribute to, at some point, the stock market is going to recognize those profits. So stock prices can go up, have a pretty good chance of going up. Again, this is the short-term dynamic. So why is it in a country's best interest to devalue their currency? Well, basically because they can increase their exports, make their goods much more cheaper and more competitive, increase exports, increase sales, increase the economy. If you're going to increase export more goods, it's going to increase need for labor, for increased jobs, increased consumption. Those are all good things for the economy. Now, the problem with that, and it sounds really good so far, but in the long term, things could happen. Problem is with a depreciating currency is that it makes the cost, and I'm going to use the falling US dollar as an example. Decreased US dollar makes cost of importing go up. And what happens is, and if there's types of imports that in the US that are really highly desired and really coveted, and people need those type of imports and types of goods that they can't make here, they'll look for substitutes. And ultimately, the substitutes will be lower quality. So ultimately, lower quality, lower value, value added. What you're going to get in the long term is sort of a misallocation of resources. And ultimately, you're dealing with a lower standard of living. So the reason why devaluing is so appealing, especially when we're looking from a political side of it, is because you get that really short-term it's like a short-term stimulus. You get all kinds of good things happening in the short term. And, from a political perspective, that's great. Make the people happy. Chances are you're going to keep your job longer. Problem is, long-term, you're really eroding the value and the quality of life and the standard of living of your life of people in that economy by taking on a very devaluing, depreciating currency policy. So, short-term good, long-term not so good. That's the impact of what a currency devaluation could have on stock prices.